Berkshire Hathaway CEO Warren Buffett is recognized for making shrewd investments that have helped his business outperform the market over the years. So it's hardly unexpected that Class A shares of his holding firm outperformed the S&P 500 in 2022. On the other hand, Jamie Dimon, CEO of JP Morgan Chase, JPM 0.48%, the largest bank in the United States, gives a great viewpoint on the US and worldwide economies. Dimon stated in the bank's most recent results announcement that the US economy is still robust and that consumer and business spending is good. Welcome to our video about Warren Buffett versus Jamie Dimon. Before we continue our video, subscribe to our channel and hit the bell icon for more informative videos. With the stock market anticipated to rise this year, it's a good time to look at two Buffett stocks that got 2023 off to a fantastic start. Taiwan Semiconductor Manufacturing, TSM, 2.27%, also known as TSMC, and Floor Decor, FND, 1.47%, have increased by 28% and 25% respectively this year. Let's take a look at why these two stocks might skyrocket and why they are still worth purchasing despite their recent increases. 1. Taiwan Semiconductor Manufacturing. Given the company's fourth quarter 2022 performance, Taiwan Semiconductor Manufacturing TSMC stock's remarkable growth in 2023 may appear a little surprising. Despite excellent year-over-year growth of 27% in revenue to $19.9 billion and a 58% increase in earnings to $1.82 per share, the company's projection was disappointing. TSMC sales projection of $17.1 billion for the current quarter is a slightly year-over-year decrease. Furthermore, experts do not anticipate the firm to match its stellar 2022 growth this year, as sales is expected to be basically unchanged. Earnings per share, on the other hand, are predicted to fall to $5.75 in 2023 from $6.60 last year. However, a deeper examination of TSMC's management remarks on the most recent results conference call shows why the stock price has risen despite a bleak near-term prognosis, which management attributed to the softness in the semiconductor industry. Semiconductor sales are predicted to fall 3.6% in 2023 after increasing 4% the previous year. As a result, clients of TSMC are allegedly lowering chip purchases in order to line their stockpiles with end market demand. However, TSMC is witnessing early indicators of demand stability and anticipates a solid rebound in the second half of 2023. Simultaneously, the business forecasts good demand for chip based on its 3nm N3 node. According to TSMC, its N3 chips are already in volume manufacturing and demand outnumbers supply. The 3nm chips will begin contributing to TSMC's revenue in the third quarter, which is not surprising considering the company's existing client base. With possible catalysts like the automotive and data center industries, TSMC may be able to generate stronger than expected growth in 2023 because there is currently a chip scarcity in the automobile industry. Semiconductors manufactured by TSMC for use in this area should remain in high demand. Meanwhile, data center system spending is expected to rise by 3.4% in 2023. Furthermore, the Internet of Things IoT chip market is predicted to develop at a 15.5% annual rate from 2023 to 2027, providing another chance for TSMC to beat forecasts. Overall, the semiconductor business has various areas of growth that might help TSMC beat Wall Street's predictions. And at 14 times trailing earnings, it's not too late to purchase this semiconductor company, which is still selling at a discount to the S&P 500. 2. Floor & Decoration. Floor & Decor, a multi-channel specialty retailer and distributor of hard surface flooring such as tiles, laminates, wood, wall tiles, and other related things, is owned by Berkshire Hathaway. Floor & Decor has 178 warehouse format locations in 35 states across the United States. There are also 5 design studios. Recently, the firm has experienced strong demand for its products. Floor & Decor's revenue climbed 25% year-on-year to $1.1 billion in the third quarter of 2022. Its adjusted profits per share increased 17% year-on-year to 0.70% per share. The excellent quarterly rise at Floor & Decor was driven by a mix of new store openings, and an increase in comparable store sales. In the third quarter of 2022, it will establish 4 warehouse stores. Comparable store sales increased 11.6% year-on-year, indicating that stores have already been operating for more than a year or still performing well. The company's sales projection of $4.27 billion in 2022 is a strong 24% increase over 2021. Analysts anticipate that Floor Decor will maintain its trend in 2023 with a 15% growth in revenue and a 12% increase in profits per share. It's easy to see why Wall Street expects the firm to have another strong year. Floor Decor believes that its overall addressable market opportunity, encompassing the hard surface flooring sector and related categories, is approximately $49 billion to $54 billion. This explains why the firm is focused on growing its footprint and capturing a large share of the market in which it operates. It intended to establish 13 new stores in the fourth quarter of 2022, more than double the number in the previous quarter. Floor Decor's expansion plan is said to have helped them boost its market share to 8% in 2021, up from 6% previously. Furthermore, the firm intends to increase its store count to 275 by 2024, up from 191 in 2022, and it sees the potential for 500 locations in the United States in the long term. The magnitude of the addressable market, along with the Floor Decor's emphasis on making the most of it, shows that it is designed for long-term growth. Over the next 5 years, it is predicted to have annual profits growth of more than 19%. Even better, this Buffett stock is currently trading at a discount to its 5-year average forward price-to-earnings ratio of 40. Providing investors with an excellent opportunity to purchase it, it would be wise to purchase Floor Decor while it is still selling at a low valuation, as the company might maintain its excellent pace for the rest of the year and soar higher in the long run. Dimon has recently pointed out 4 issues that might have influence on the global economy and the bank's operations in 2023, and these issues could be market changers, but these are against the values highlighted by Warren Buffett that are still here. Number 1. Tensions in geopolitics. The first economic barrier Dimon mentioned was continued geopolitical difficulties, such as the Ukraine crisis and consequent sanctions placed on Russia. In his letter to shareholders last April, Dimon stated that this battle might have long-term geopolitical implications. The sanctions placed on Russia have had far-reaching consequences for global energy, commodities, and agriculture markets. We witnessed the effect early last year, when crude oil prices soared beyond $120 per barrel and wheat prices increased by 55%. While oil and wheat prices have subsequently stabilized, Dimon warns against becoming complacent about the long-term effects of geopolitical tensions, noting that previous geopolitical crises, like as the Vietnam War, had long-term consequences that took years to play out. 2. The vulnerable state of energy and food supplies. Other factors, according to Dimon, might cause energy and food costs to resurface as issues. In an October interview with CNBC, Dimon stated that we're getting energy terribly wrong, and that a lack of oil and gas output is adding to the tension. His fear is that nations such as China, Germany, and Netherlands are returning to coal amid the energy crisis, and that greater oil and gas production will require to deter countries from choosing less sustainable energy sources. He mentioned that energy corporations are hesitant to invest in production for a variety of reasons. One issue is that these firms can't get permits done, they can't obtain leases, and investor constraints have kept energy corporations from spending too heavily in productions. He said last month on CBS Face the Nation, he believes that underinvestment in oil and gas would generate problems in the next 2 to 3 years. Because energy accounts for around 40% of food costs, underinvestment in energy will have global ramifications and may lead food prices to rise further. He also stated that the situation in China, which requires more food, energy, and water to feed its people, is another issue that would take decades to resolve. These structural forces may keep energy and food costs up for a long period of time, which relates to its next issue. 3. Persistent inflation eroding purchasing power. Massive fiscal stimulus put trillions of dollars in the hands of consumers during the epidemic. Consumers were loaded with cash, with over $2 trillion in excess savings, according to Dimon's letter to shareholders in April. In an interview with CNBC last month, demonstrated that consumers still have more than $1.5 trillion in excess savings. which would most certainly be spent down by 2023, potentially contributing to higher inflation. While some of the inflationary pressures were temporary, such as supply chain concerns, other structural causes will lead to more persistent inflation in the future. This indicates a 2 million early retirement beginning in 2022 and a million decline in immigration, all while available jobs increased and salary growth accelerated. Another element contributing to stickier inflation is the lack of housing supply, which will likely keep house prices high. These factors have contributed to sustaining inflation in the United States, while geopolitical difficulties around oil and food costs have contributed to global inflation. Dimon's next concern is the government's reaction to inflation and how it will affect the market and the economy. 4. Unprecedented quantitative tightening. The Federal Reserve's quantitative tightening QT is the final possible economic headwind. QT is the inverse of quantitative easing and is used to remove funds from the financial system. To combat inflation, the Fed is boosting interest rates while implementing QT, which is in no manner classic Fed tightening. According to Dimon, this would result in a large outflow of cash from treasury bonds and other securities. He stated that, unlike from 2008 to 2014, when banks purchased bonds as the world deleveraged, they no longer needed to purchase treasury to strengthen their liquidity ratios. This significant shift in the flow of capital has an effect on the market and the economy, and the bank has been prepared for higher interest rates and more turbulent markets. He also stated that the Fed should continue to tighten policy regardless of the impact on markets and should only be concerned if such measures begin to have a detrimental impact on the broader economy. Dimon believes that the benchmark's federal rates must reach 5% before the Fed considers slowing the pace of rate hikes. It is presently at 4.5% on the high end. We don't know how Buffett investigates investments because most of his investment process is secret. You don't have to do anything spectacular to invest like Warren Buffett. In fact, many new investors are taken aback by the Oracle of Omaha's straightforward investments technique. Buffett buys in outstanding companies that are selling for less than their true worth, and then he keeps the investments for as long as the companies stay great. Obviously, there is more to the tale. Simply said, he is the best in this race after this thorough examination. So this was all about the video. For more videos, make sure to subscribe to our channel and hit the bell icon for more videos. Thanks for watching and have a great day.